Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out the charts that seem to be really saying something right now, and I put them into three categories: positive, negative, and what we're watching for right now because we're not sure if it's positive or negative. We just want to keep an eye on it. This is being prepared for Monday, May 5th. The first area that we're going to go through are the positive areas as we see them. Now, with most of these charts, you can pick out negative things, and I'll try to point out both the positive and negative. And some of these I could have easily switched sides on them. But since we had an up week, the intraday chart looks pretty good. And we were really not looking so good on Wednesday. That's when the initial GDP number came out, and it had GDP down, it had inflation up. The market ended up gapping quite a bit lower, but then we saw a nice little bounce coming back up from that. That carried over into Thursday, even though we opened and then closed lower at the open. That wasn't all that positive there, but the gap is what gave us most of the gain. And then in Friday's session, there was positive reaction to the employment report. We ended up coming up to the 5,700 level. And I have it marked here because it's not a technical level, it's a psychological level. And the financial media likes to talk about it, and people like to refer to it. Well, the market's now turning that into somewhat of a technical level. Another area that's improving, finally, I thought never would we ever get above 25 ever again. Well, we are. And so when we're extreme negative, we use that as a contrarian indicator. When we get extreme positive, contrarian. But while it's going in the direction that it's in, we tend to go with that. And we are seeing an overall improvement with sentiment. Now we're still below 50. It'll be even more positive if we can get back above 50. And we're switching over positive. Finally, this was one of the last holdouts because of all this choppy that was going on here with price action. Our trend indicator was having a heck of a time trying to figure out what was going on here. Well, if you look closely, you can see where the green line is just barely crossing above the red line. This is the short-term ADX. I use this to determine the condition of the trend. Now, it's still a weakening trend. In fact, we're technically not in a trend right now in the short term because the black line, which is the ADX, is below 20 and we're below the moving average. So from that aspect, we're not trending. But we did see a crossover. Now, this is happens sometimes. Not saying this is what's going to happen, but this has happened before. When we see a weakening trend that's negative, and then we start to develop into a stronger positive trend, it's common for the ADX to drop the way it is. What we're going to be watching from here, if we keep going up, is the ADX able to turn, the green line continue to go up, and are we able to get back above the moving average? That would show a strengthening trend here in the short term. And we're watching pretty much that same thing here in the intermediate term. We're still above 20 with the ADX, so we're still trending. It's really hard to see because these lines are all on top of each other, but the green line is a little bit above the red line. You can see the numbers over here, the green and the red. The green is just a little bit higher than the red number. So that's turning the intermediate term trend to positive, but it's still a weakening trend. We are looking okay here. We want it to continue. This is an intraday chart of growth to value. We want the blue line to be above the red line. That means growth is outperforming value and the market's turning more offensive. We're also looking okay here. When we look at our S&P growth to value intraday chart, this continues to go up for the most part. And when we look at small cap growth to value, we're just barely hanging on to an uptrend. We are bouncing back up. Now, small caps have just not done well in 2025, but this is encouraging. At least their small cap growth to value ratio is looking a little bit better. We're also seeing an improvement here with mid caps, which also have really struggled in 2025. We're improving, but not positive all the way here with the growth to value ratio between these two ETFs. We're coming back up into the rainbow, and we're seeing some signs of improvement here. The Qs to S&P above an advancing moving average. What's not as positive is discretionary to the S&P. We're right on top of the moving average, and the moving average is flat, but we are seeing an improvement when we compare large cap growth to large cap value. So we're seeing an improvement across the different indexes with the large caps, mid caps, and small caps. And this is value. In a more positive environment, when we do a value to tech ratio, which means growth, we want this to go down. When value is outperforming, this ratio goes up. And so we have been coming down here. This is what we were seeing in 2023 and into 2024. Well, we were starting to go back up here in 2025. Now, this hasn't switched over yet, but it's at least coming down. We need to get below the rainbow, stay below the rainbow, and then see the lines start to roll over. That would be more positive for the market. And we're improving here internally. This is longer term, a 10-day average of the highs and lows for the S&P. We're back above 50 and improving after getting a really low reading here. Now, this is still technically negative because we're in a downtrend. This is S&P growth of value. But the reason this is positive is we were able to get back above the 50 period moving average and the 200 period moving average, but we are still in a downtrend for right now. We need this to continue to go up, see the lines turn, see a golden cross here, and that would improve things quite a bit. We are improving here when we look at the risk on to risk off ratio. When this is going down, the market's becoming more risk off. That's when we're going down. When this is going up, that means we're more risk on, and that's positive for the market. We're also seeing the high beta to low beta ratio improving. When the market's more positive, folks want to get into the high beta stocks. These are the stocks that outperform the Google, Apple, Microsoft, Netflix, Google, the stocks that tend to do better than the S&P 500. Beta is outperforming the benchmark here. Where low beta stocks, that's toilet paper, toothpaste, the things that are more defensive. So we are seeing a real improvement overall with this ratio. We're not positive here by any means, but we're improving with the large cap growth ETF. We were able to get back above the 50 period moving average, but we're still below the 200-day moving average. So improving, that's why it's positive. This is that same thing, but showing a rainbow where we're coming back up into the underside of the rainbow. We need to keep going up here, cut through the rainbow, get back above the rainbow, and see the lines turn back up to be more positive. Now, this is positive, but maybe too positive. These are all the stocks in the S&P 500 that are above their 20-period moving averages. That's the short-term trend. Now, we're positive, but you notice here, we're at 86.6% of all stocks in the S&P above their 20-period moving average. Quite often when we get to a level like this can mark at least an exhaustion. It doesn't necessarily mean a reversal. Like right here, we did chop sideways for a while and then declined. Other times, we were able to keep going up. So it doesn't mean that this indicator is the end all. And then we've been all choppy here in the 2025 so far. But this is just something to be aware of. And this is that same thing, but just showing it a little different way. This one has the line at 70. And this is just showing that we're looking pretty good in the short term. The previous chart here shows us above 80. That's when we're starting to get more extreme. Okay, and then we're improving here. We've been below 50 with those stocks in the S&P above their 50-period simple moving average. Well, we finally crossed back above 50. So this is improving as the S&P has been going back up. And we're back above the 50-period moving average on the daily chart. Now, we're still in a downtrend. It's not a bear market. It's just a downtrend. We're not in a bear market until we fall 20% on a closing basis from the all-time high set in February to wherever we go from there. Now, the VIX, it's still negative, but the momentum of the VIX is coming down. And that's what we want. When the VIX is declining, that's more positive for stocks. This is really encouraging here, and it's a weekly chart. And these are pivot points, and I think these are pretty important. You can just go back and see when we hit these pivot points, and that ended up being a pretty significant thing that happened. The cool thing about pivot points is they're calculated ahead of time, so we know where they're at. Well, when we were really coming down, we fell down below this pivot level. That was negative. We came down. We actually broke below this S1 level, came down, but then we were able to get back above it. That was positive. Now, as we're inching our way back up, we were able to get back above this pivot point now. Now, this is a weekly chart. It won't update for another week now. We need to stay above this, and this pivot is at 50, 55.75. So it might be an area that you want to keep an eye on there if we start going down, because we're at 56.86 now. And this is positive because we're no longer in correction territory. We're back in pullback territory. When we're above this dashed line, that means we're down 10% or more. And we got close to that 20% area, but not quite there, at least for this time. And then this has been coming down as the S&P has been going up. So that's improving there. The advanced decline line based on price and volume, those are positive. We're above advancing moving averages. And this also, the advancers, decliners, this is an oscillator over a 10-day period of time. When we go above this red line, we're starting to look kind of extreme here. Again, it doesn't mean a reversal, but it could mean that we slow down, but it can mean a reversal. We just need to watch this in the context of with some other charts. And the advanced decline ratio in the short term, that's blue, we're getting extreme there. We are improving though with the new highs, new lows. Now we were coming up with the 5-day and the 10-day, not because of strength, but we were seeing a lack of weakness. It was a contraction of the new lows. We're finally starting to see some of the new highs, the green, advancing here. We need to see more of that. And if we're going up because the green is outpacing the red and the 5-day and the 10-day are going up, that's positive. Where this was a little misleading here. We were going up because of a contraction in the new lows. We're positive with our smart money indicator number one. We're above the red line, which is a moving average. That's positive. And then the boom indicator is going up and it's above its moving average as well. And we're just turning over to positive with the Landry light. This is red. And for the longer it goes on, the longer these lines get to show how long that trend has been in place. But it's really hard to see, but we're green over here now. So that's turning to positive. And we're improving with the short-term trend based on 20 periods. We're above the blue line and the green line, and we're going up. The lines are going up. That's improving short-term. We're above the 20 period simple and exponential moving averages, and the lines are starting to turn up now. The intermediate term trend is also improving. We're above the blue line and the red line with the 50 period here, and this is turning back up. So that's looking better. And we're above the 50 period simple and exponential moving averages. That's improving. That's why we're back to positive in the intermediate term. And the rainbow, the short-term rainbow, going from 10 periods to 50 periods, we're coming up out of the rainbow here. The longer we can stay up here, the more these lines will turn up, and we might be able to turn back positive in the short term this way. This is an intermediate term. Now, this is still actually negative, but at least we're coming back up into the rainbow, and I like to keep these charts together. There's also a long-term one that I'll show in a moment here. Now, we're positive with this, but we're getting far away from the 20 period moving average. This is the boom indicator, and you can see we're way far away from that 20 period moving average. And quite often when we get a reading like this, price will have a tendency to snap back to the moving average. We are going back up through some of the anchored moving averages here. We were able to get back above this purple one. This was a recent anchored moving average that I added from the all-time high. We got back above that. Now we're back to this light blue one. This is what we were battling before we really broke to the downside. This goes to a low set back in April of 2024, just a little over a year ago. We're able to get back above that. Now we're dealing with this orange anchored moving average, which is likely providing overhead resistance. And we're extreme positive here with the rate of change going back 10 periods. If you count all these bars, it's probably one of these lower bars here. And sometimes when we get really high readings like that, it doesn't mean we'll stop. It just means we might slow down. Also, the rate of change going back 20 periods. This really shot up in Friday's session. It was actually below the midpoint. And then with Friday's advance, it really came up here. Not really extreme right now, but turning from negative over to positive. And then the S&P McClellan oscillator. This is starting to get extreme because we're above this 60 level. Again, doesn't mean we'll reverse, but it might mean that we're getting near some kind of a top of some kind where we might end up going sideways for a while. But when we look at the summation index based on price and volume, those are positive. And then we look at the NYSE McClellan oscillator. This is also getting extreme as well. But we're going up with the summation index based on price and volume for the NYSE. The Swindon Trading Oscillator based on price, it's really hard to see. We are turning back up here based on volume. And then we have the Price Momentum Oscillator, which is an indicator developed by Carl Swindon. He has one for every stock that's in the S&P 500 and then puts them all together. And that's what's measured here is one unit. Well, when we look at those stocks inside of the S&P that have PMOs rising, we're getting extreme here. And sometimes this marked either a top or at least a slowdown. We're also getting extreme with the buy signals, but we are still improving with the PMOs that are above zero. We're positive with the parabolic SAR daily chart. The dots are underneath, so that's looking good there. We're positive with the Chaikin money flow. This is smart money indicator number 2. That's improving. It actually turned negative after Thursday, but switched back to positive after Friday. And we're coming down a little with the green line, but we're positive here with the vortex. We're positive with the slope oscillator. This is a short-term oscillator, but you see how we're really getting extreme right now with that particular oscillator. And here you see it with all the other oscillators to show just how extreme we're getting. We are positive in the short term, and then we look at our 3 intermediate term oscillators, they're positive, and our 2 long-term oscillators are also positive. And we're coming up, the bullish percent index was one of the stronger things that was leading us to believe that we might be bouncing out of this downward move that we've been in. But we're possibly getting too extreme here. We're getting up to this green line, which is at 70. We're at 70.2 right now. When we get above this, again, sometimes that can suggest some kind of exhaustion, not necessarily a reversal. And we're also getting extreme with the NASDAQ 100 bullish percent index. We're above this 70 level as well. We're positive here. We're seeing a lot of X's drawn in with the point and figure chart. This is a triple top breakout that was generated because we were in this box area right here. And we've been able to break out of that after trying 3 times. And we're actually breaking above this downward sloping trend line here. This is also positive. When we were really going down, this goes back to October 2022 to February 2025. We came right down to the 50% retracement level. And that's where the smart money came in and said, no, we're going to start buying right here. And buy they did. Now, we don't know if we're going to pull back, what's going to happen going forward here. But this was positive, and it's still kind of in the background as part of the recovery. We were also able to get above this 38.2% retracement level. And then gold is, you've probably been hearing about it. Gold's going to the moon, going to the moon. Well, not this past week. We look at a ratio of gold to the SPY. And what's interesting about this chart is that we made a high back in 2016 and another one back in 2020. I connected these. I actually got this idea from Chris Shavako from Shavako Capital and then you just extend the trend line going down. We came right up to that point again, and this ratio is starting to come back down. This is coming down because gold is going down as stocks are going up. And if this ratio keeps going down, that will be more positive for stocks. Longer term, we're back above this long-term trend line going back to the 1987 crash. We've been above that. We were able to get back above that one. This shows it a little more here, where we're back above the red line. And we're still above the midpoint. This was part of the area that was held on to as part of support. And then we were able to bounce up from that. This also is a trend line going from the October 2022 low to the October 2023 low, extending that forward. We came down here, and then that's when we started to go back up. And then we look at a monthly chart of the S&P. This is long term, and then a 50-month moving average. We got close to this, but the takeaway too is this is positive because the blue line is still going up and price is still above the blue line. So this is very long term, still looking pretty good there. Then we switch over to some other markets. The advanced decline line, we're looking more positive with the NYSE common stock, S&P mid caps and small caps. Now, some of these moving averages are still declining, but we're above the moving averages here. And so that's why this is looking more positive. Now we look at the Dow, and you're going to start to see a pattern here. We're starting to hit overhead resistance, not only with the S&P, but on other indexes, and we're seeing a convergence of that. One of those is the 50-day moving average with the Dow. That's just about where we closed on Friday. Now, we're not hitting any resistance, at least here. We're in a downtrend here with the NASDAQ, but we are improving because we got above the 50-day moving average. What I think is even more important is the NASDAQ 100 because the NASDAQ 100, those stocks are also in the S&P 500. The NASDAQ 100 is growth, where the S&P 500 is growth and value. And see how we're coming right up to the 200-day moving average, and we weren't able to close above that on Friday? That might turn into something when you combine it with some of the extreme readings that we're seeing right now. So that's why we want to just keep an eye on these different things. The NASDAQ 100 momentum, though, is positive, and the weekly chart's looking pretty good. We're seeing a series of higher highs and higher lows here as we've been coming up out of this with the QQQs. Small caps, believe it or not, we're actually using their chart here because they came right up to their 50-day moving average, and that's where they closed on Friday. So this may end up providing some resistance. So we're seeing it with the Dow, the small caps, the Nasdaq 100, and later on we're also seeing it with the S&P as well. The Wilshire, it's positive because we're back above the 50-day moving average, but we're still in a downtrend here. Same thing with the total US stock ETF, above the 50-day moving average, but still in a downtrend. The FANG index just generated a death cross here, so we're in a downtrend, but about the time that got generated, we just really started to see an improvement here with these really big stocks that make up this index. And this is improving, but not full-blown positive. Staples to tech ratio. When this is going down, that means staples are outperforming. That's more defensive. Excuse me. When this is going down, that means tech is outperforming. When this is going up, which is what we've been seeing in 2025, that's more negative. That's when the market was going down. Well, we're not switched over yet, but we are declining here with this overall ratio, even though it's still in an uptrend. It would be more positive if this ratio continues to fall. That means that tech is outperforming staples. And long-term chart, I seem to show that every week in this video. The NASDAQ 100 growth versus Dow, which is considered value, we're still above this red line. That's holding up with that ratio. And then the Qs to the small caps, the Qs are doing pretty good. The small caps are still languishing here. We're still seeing this ratio going up. And then we did last week have a ZWAG NYSE breadth thrust that was triggered. Now we're coming down here, but once this is triggered, that's kind of on the books. And so we just kind of keep it there. And then we are coming down with the staples to S&P ratio. When this is going up, that means staples are outperforming. When this is coming down, that means the S&P is outperforming. But we don't really know if this is a legitimate spike until there's a bit of hindsight to know about this, because we get a lot of false spikes along the way that look authentic, but only to see them replaced by an even higher spike. But as this continues to come down, that is more positive. And then here is the SOX. These are the semiconductors. Even though they've been under a lot of pressure, even though they've been underperforming, when you look at the 200-week moving average, we're still above that, and the blue line's still going up, and we're above the blue line. So long term, the semiconductors are still hanging in there. Now we look at the negative side. We are still extreme negative with investors' intelligence. This came out on April 29th. We've been down here for about 3 weeks now, but we use this as a contrarian indicator. But we've been down here for a while. If we had used it 3 weeks ago as a contrarian indicator, it would not have been a good thing. So we're wondering now, this is still negative in the context, but are we going to be able to bounce up from here? And then that would show an improvement with sentiment. And we are coming down with the VIX, but we're still above 20. So that's why it's negative. But the context is that it is declining. And when we're above 20, that's when we get negative annualized returns. And this is a chart put out by Tom Bowley, who is with stockcharts.com and earningsbeats.com. And sentiment for 10 weeks in a row now with individual investors has been extreme negative. Again, we usually use this like a contrarian indicator, but not when we've been camped down here for 10 weeks. So we'll see. With the positive week that we just got done with, maybe we'll bounce back up a little bit here. And even though we've been going up with the S&P, we're still, for the most part, below average with volume. And that's a classic technical analysis negative divergence. When you're going up and you see a lot of conviction behind it, you will see an increase in volume. Like when we were coming down, see how big the volume was there? And now we've been bouncing back up on lower volume. Not the most important thing in the world, but still an important thing to be aware of. And even though we're improving, we're still below the 200-day simple moving average. We're 1.03% below that, which means it could end up providing overhead resistance. This is another indicator called proper order. Even though we're positive with some other charts, this chart, it's red, so it's still picking up the trend as being negative. And with our other smart money indicators that are positive, for some reason, our third smart money indicator, the chicken oscillator, it declined on Friday. Even though we had a pretty solid up day, this coming down is a concern. So it actually turned negative and dropped below its moving average on an up day. It's picking up something that it doesn't like. And we're improving here with the 100 period moving average study. We're getting above the exponential, that's the red line. We need to get back above the green line, which is the 100 period simple moving average. So that's why it's still negative, since we're below these lines and the lines are still declining. And here we just got this spaghetti mess here, but we are positive in the short and intermediate term because we're above the 20 and 50s, but we still need to recapture, and we have a lot of overhead resistance with these moving averages that are still above current price. And we are improving with those stocks above their 200-day simple moving average, but still below 50. And those stocks above their 100 period moving average, improving, but still below 50. And we're still negative with the long-term trend. The red line, even though it's coming down, it's got a long ways to go. The green line has a long ways to come back up to turn our long-term trend positive. And this is actually a strengthening trend. It's above 20 and it's above the moving average. And this is still going up. It hasn't rolled over yet. So this is longer term, just something to be aware of. And we're negative on the parabolic SAR weekly chart, where we're positive on the daily chart. This is, to me, something kind of big. Now, this is another fib retracement. Now, this goes back to the low set a year ago, April 2024, and then the high that was set in February 2025. We came all the way down. We were able to hold on to this full retracement. We actually went a little bit below that before we finally bounced back up. But we were able to get back above the 38.2% retracement. We got above the 50%, but look at right here. We're at the 61.8, and we didn't close above that in Friday's session. This is some of the S&P resistance that I'm talking about. We're seeing it on the Dow, the Nasdaq 100, the small caps, and here on the S&P. It's a convergence. Now, could we break through that? Of course. That would actually be more positive if we break through all of this resistance that we're seeing. But we've had a really solid up run here with 9 straight days. I believe that's what it was for the S&P being up in a row. And you think somebody at some point is going to want to come in and take some profits. And it might be that they see all of these moving averages and these retracement levels all coming together and say, okay, today might be a good day to do that. And we might see a pullback from there. And then if we do start to pull back, we'll just reevaluate things as we're going down to see how much intensity there is or isn't with that happening. And this is still negative overall, but we're improving when we look at the discretionary to staples equal weight ratio. We're in a downtrend. We are coming back up to the 50-day moving average, but we need to see more from this. And we want to keep an eye on this. We're seeing a divergence developing here with the S&P to the home builders. This has been coming down. If it goes really down to a low level, that's where I have this yellow area here, that's going to produce a negative divergence, which sometimes can be negative for the S&P. You can see when this happened last time, we went sideways for a while, but then saw a bit of a decline there. Doesn't mean the end of the world. We just want to be aware of this. And then we look at the S&P 500 to 3 to 7 year bond ratio. We're coming up here, but we're still below most of the rainbow, thinking that we're going to be going into a hard landing, which means a recession. And you're going to see a lot of similar charts after this. After this one, this is an inverse of what we just looked at. And this shows where bonds were starting to outperform stocks. Now they've been pulling back. These are the series of charts that are going to look about the same. The S&P 1500 is short-term bonds under the rainbow, but improving. Broad market 3 to 7 year bonds under the rainbow, but improving. Tech, the 3 to 7 year bonds under the rainbow, but improving. Kind of the same story, but we're getting confirmation here. The Qs, the 3 to 7 year bonds under the rainbow, but improving. And then home construction. This was one of the first areas to turn negative. It went negative back in 2024. And this was giving us a heads up that something's not right here. And we've been coming down. we're still negative overall because the rainbow is falling down here with price, even though we did bounce back up recently. And then longer term with the daily special K chart, we're underneath the red line, even though we are turning back up. That's negative. This is a long-term oscillator. And we're still below the rainbow. I showed the short and intermediate term rainbows on the positive side. I'm keeping this one on the negative side because we're just kind of scraping back into the bottom end of the rainbow for now. And we are improving with the 50 period moving average of the new highs and new lows for the S&P, but we're still below zero, even though it's bouncing back up. We're looking at the semiconductors to Dow ratio that, for the most part, continues to fall. That's negative. And then semiconductors are negative. The Dow Jones Semiconductor Index, it's coming back above its 50-day moving average. I could have thrown this on the positive side because we're above the blue line, but we need this to really improve since semiconductors are such a huge part of growth. And then the semiconductor ETF also trying to get back above its 50-day moving average, but still in a downtrend. Semiconductors trying to come back up into the rainbow. You can see we've been down here long enough where the rainbow is starting to fold over and roll over right now. Okay, and then if you didn't get it the first time, here is another look at the semi to Dow ratio, which is negative. I have that chart on here twice. And then semis have not been outperforming tech. Early 2024, we saw this ratio going up. That means semis were outperforming. We topped out in the summer of 2024. We've been coming down. And as I've been saying, we were still going up with the S&P. We were still setting all-time highs, but it wasn't being led by the mega caps or the semis or tech. It was other areas. Discretionary was doing pretty good at that point. But then as we got into 2025, this ratio just kept on declining. We want this to go up to be more positive. Now, we want tech to go up too, but it's more positive when the semis are even doing better than tech, and that's what makes this ratio go up. And then we look at this. Now, these are still negative, but improving. We look at discretionary to staples. That's the weighted version of these sectors. In a downtrend, but improving, you're going to see the same thing here. Discretionary equal weight to staples, what I just showed, negative, but improving. Tech to utilities, negative, but improving. Biotech to healthcare, negative but improving. Hotels to utilities, negative but improving. Then benchmarks, semiconductors, negative but improving. Home builders, we hope they're trying to improve, but not really breaking out. That's why we're seeing that negative divergence between home builders and the S&P. The transports are trying to bounce up here a little bit. Retail's trying to bounce up too. And regional banks, we want them to do well. We don't want another Silicon Valley Bank or Republic Bank. We want this to keep going up. Now, this is concerning, and this is longer term, and I've been bringing this up for quite a while now. This is the SPY, which is the ETF for the S&P 500, to staples, toilet paper, toothpaste, ratio. We saw this really start to come down at the end of 2021, and then we went into a bear market in 2022. We're still seeing that same basic deterioration here. Now we're improving. We're trying to come back up here, and we could negate this by this ratio still going up even more than where it's at now, but it's still looking a bit vulnerable. So we just want to watch this unfold day by day with this, and I update this in the daily videos. And then longer term with the weekly chart of the NASDAQ 100, we're bouncing back up here, but we're still below this trend line going back to 2009. Now, the areas that we're watching, we want to keep an eye on jobless claims, the employment situation. If that really starts to go down, that probably means we're going to go into a recession. And that's why the market really reacted positively on Friday because they expected a weak report. It actually came in stronger than expected. Now, on Thursday, we got jobless claims. These are initial claims, and we're spiking up, but we're not really breaking out of this recent range that we've been in. If this continues to go up, that's going to be a real concern. And then we have continuing claims, which did spike up after being in a range here. We'll keep an eye on this. If this keeps going up, that's going to be more negative. And then we have all three together with the initial claims in red, the continuing claims in blue, and then the most recent unemployment rate at 4.2%, all here on one chart. And the mass index, I just put it in the watching section because this has been triggered now that we fell down below the red dash line. And that would signal that we should look for a reversal to go down from here because it was when we were going up, that's when this signal was generated. This other signal was generated and then we kept coming down. But now we have another signal here. And then this is almost becoming irrelevant. This is a Pring bottom fisher. We saw a crossover here back in about two-thirds of the way through April. And the further we get away from this cross, the more irrelevant this becomes. It turned out to be a pretty stinking good signal. I mean, you would have got bumped around quite a bit here, but this ended up being pretty legitimate. But another day or two, and I'm probably going to take this chart away because we're getting further away from that signal. And we want to keep an eye on interest rates, specifically the 10-year bond. It's been 10-year yield. It's been coming down, but then we saw a bump up. Now that's because the employment report was stronger than expected. And the bond market's been anticipating economic weakness. That's why it's coming down. Well, then they saw some strength and they kind of freaked out, and we saw interest rates going back up. And we want to keep an eye on the spread between risky and not as risky bonds, like risky bonds like junk bonds versus government bonds, which are not risky. This was really coming down. Now it's starting to improve. So I look at this more as a sentiment gauge. And then this is also, we're looking at the interplay between interest rates and inflation. And this chart is telling us, since this ratio is going down, that from a 1 to 3 month T-bill to 3 to 7 year bond rate ratio, the market's not concerned about inflation or interest rates. If this ratio was going up, that would show concern, like it was going up here last fall. This ratio has been coming down, and we're actually seeing a death cross here with this ratio. So in the short term, the market's not concerned about interest rates based on what the bond market is saying. We're seeing that same basic thing when we look at tips, which do adjust for inflation and interest rates, and we do a ratio of 3 to 7 year bonds. This ratio is continuing to fall, and we're seeing this going into a downtrend as well. When we have inflation worries is when this ratio is going up and it's going down. And then we look a little further out, tips to 7 to 10 year bonds. This ratio is, for the most part, still coming down, even though it's hanging on to an uptrend. And we want to keep an eye on the 10 to the 3 month yield curve. We're back even now, where the 10-year yield and the 3 month yield are the same, but we had gone inverted here. And if we now continue to go back up and be more normal, that usually begins some kind of a countdown to see if we're going to go into a recession. And as I've said in other videos, it's not like, okay, 94 and a half days and we're going to be in a recession. It just means we start watching our recession charts more, because we're already watching the 10 to the 2 year. That's back to inverted and that's getting steeper. So we're watching our recession charts for that reason. If this goes back to being regular again, we're going to start watching those recession charts even a little bit more now. And then oil is actually dropping down. We're getting into the high 50s where we had been in the low 60s. And the dollar, which is back above 100 but is still in a downtrend, we're just keeping an eye on this just to see how it's behaving. So thank you. I hope you found this helpful. I do update this information every day in the daily videos. Feel free to check those out and see if it's helpful to you. So have a great weekend, and I will talk to you in the next video.